everyone, and welcome to AIADA's Auto Talk. I'm your host, Rachel Soleimani. We took a little summer break, and I hope you all did too, but we're back again. But since it's been a bit, a few reminders. Anyone who is registered for today's program will be receiving a copy by the end of this week, or actually, it's Thursday. We're doing a special presentation for Charlie. So by early next week. And if you have any questions, be sure to enter them into the Q&A bar at the lower right-hand side of your interface. Now, please join me in welcoming our dear Auto Talk friend, Cox Senior Economist, Charlie Chesbrough. Charlie, I know you have a lot to cover, and I feel like I say that every time we have you on, but I'm really looking forward to today's program, so I'm going to let you take it away.
All right. Well, thank you so much. And we certainly do have a lot to cover, and I apologize ahead of time, but we will be sharing these slides later, so you're welcome to look through them. And if you have any further questions, please hunt me down. I'd be happy to answer them for you. But I'm titled my comments today, Certain Uncertainty Ahead, because we really are entering a phase in the U.S. economy with the election coming up. And for the vehicle market, there's just a lot of unknowns that we're looking at here through the rest of this year. Maybe the biggest being is what's going on with Federal Reserve interest rate policy, and we're going to talk a bit about that in just a moment. But some of the topics I want to talk about today is give you a quick update on what we're seeing with the economy and the new vehicle outlook, talk a little bit about the election and what it means, and as I said, the certain uncertainty that it's going to bring. And then talk a little bit about the brands and what they're doing out there right now in the marketplace. Some are more vulnerable than others. And then at the very end, I just want to talk for a moment about used prices. As you know, they've been falling for a long time, but we expect that they're going to start to stabilize soon. But we're not quite there yet. But the outlook does look like we're going to see some tightening of prices on the used market. So just to summarize where we're at with the economy and the industry, we're looking at a situation where we've got a slowing economy with high interest rates. The rate of growth of the economy appears to be slowing dramatically. There's a lot of concern that we may be on the verge of sliding into a recession. We're going to talk a little bit about that in just a moment. What we're also seeing is that the supply of vehicles has now stabilized. We spent the last couple of years going through a big crisis of lack of availability, and then we got a surge of availability. Now we're seeing it's moderating. We're seeing that the growth of vehicle sales is more, of supply is more or less stabilized. But there are some brands that still have way too much inventory, and other brands that just still don't have enough. And that situation leaves it quite varied out there. But all of it means that we have a change in the marketplace, which is declining pricing power and improving affordability. We saw prices rise dramatically over the last couple of years, but they are now coming down. And the affordability issues for consumers is getting a little bit better, but it's still a major headwind that we're looking out there. And as I said, the fourth big issue we're dealing with is the uncertainty that we're looking at going forward. Will the Fed be lowering interest rates? We're going to find that out in I guess about 10 days from now. They're having a big meeting. We're going to find out about a new interest rate policy and the election. And that's going to have a lot of unknowns for the marketplace. And we'll talk about a few of those here in just a moment. But let's talk about consumer spending and where we're starting right now. And this is a chart that comes from Equifax, and it's data that's looking at credit card activity from consumers on a year-over-year basis by week. So we're comparing this week versus the same week last year. And this is showing you 52 weeks of data here. And it's a little choppy, but that dotted blue line is showing the 3-month moving average. And you can see that the pace of consumer spending has been slowing, and that's what I've highlighted there in red. And that's the real concern, that we're looking at consumer spending that is almost half of what it was just a few months ago. And the concern is that maybe this is indicating that the economy is heading into a recession. Consumer spending is a key part of the U.S. economy. It's almost 70% of all activity. It's you and I going out and buying stuff. And so if we see consumers are pulling back from the marketplace, it could indicate that the economy is in fact headed to a recession. We aren't expecting that just yet. We're expecting that the economy is going to slow and not slip into a recession. But clearly, there are indications out there, and this is what Wall Street is looking at closely because this is all going to influence what is the Federal Reserve going to do. The big issue that the Fed is dealing with is inflation, and this is looking at the consumer price index, the year-over-year change in the basket of prices. And you can see of where we were in June of 2022. This saw a peak of over 9%. We hadn't seen in almost 40 years, but the inflation rate has been coming down, and it's been coming down rather quickly, uh, at least initially. But it's been a little bit more sticky the last, well, really the last 12 months of the year. It's been harder to get down this last little bit of inflation. We're now at 3%, so we've gotten it down substantially from the 9% we were at. But the Fed's target is to get down to a 2% inflation rate. And that last little bit's going to be the real challenge. We're seeing that housing prices in particular remain quite sticky because supply really hasn't improved dramatically. There's just not a lot of activity going on in housing, and that's keeping prices relatively high. But when we look at goods, many of the goods out there are actually looking at negative year over year prices at this point. So inflation is not universal across the economy. We are seeing sectors of the economy that are actually seeing prices fall, as we're seeing in the new and used vehicle markets. So the expectation is that the Fed is has been able to beat inflation enough that they're going to be able to change their interest rate policy next month or later this month, and we're going to start to see some interest rate cuts. Now the expectation is that it's almost certain they're going to do a 25 basis point cut on the 18th of September when they meet. But there's about a 50% chance that they may actually do a 50 basis point cut. There's a little bit of a scuttlebutt out there as to how much the Fed's going to cut, but almost everybody's in agreement that they're going to start cutting something here, as I said, on September 18th. And the reason is that because the soft landing appears to have been managed. That was the goal: is can they raise interest rates, slow the U.S. economy without sending us into a recession, and without having anything sort of majorly disruptive for the jobs market. And as we can see, this is looking at job growth, the number of new jobs that are created each month. And the 3 month moving average, that orange line, you can see that it has been falling. The number of jobs that have been created has been trending lower, but it still remains positive. So we got out of that fast growth environment that was really causing much of the inflation. And the job growth has now slowed dramatically, but it hasn't gone negative. And that's the key. That's why folks are very, very optimistic that the soft landing has been achieved. We're going to get a jobs number tomorrow. And that's going to be a very important number for the market and sort of will dictate to the market what is the Fed going to do. At least a lot of the traders are watching it closely. And the expectation is that we're going to be looking at around 160,000 jobs created and then the unemployment rate falling to 4.2%. So they're looking at sort of a more of the same kind of environment tomorrow. If we see something substantially different, we may see the market react rather volatilely in response to that. But overall, the unemployment rate still remains very, very strong. This is showing the unemployment rate going back about 70 years worth of data. And you can see where we are on the far right. I've circled it in green. The unemployment rate has ticked up a little bit. We're now at 4.3%. It's, as I said, it's expected tomorrow to maybe be a little bit lower. We'll find out. But it's risen from where it was a year ago. A year ago, at the same time, we were looking at a 3.5% unemployment rate. So clearly, the increase of interest rates has slowed the U.S. economy, has changed the employment market, but it hasn't caused us to go in any sort of hard landing scenario where we're looking at major job losses out there. So the outlook right now in terms of what the Fed's been able to do remains quite positive. We can see that the stock market has been reacting very positively. Equities are near all-time highs. And so there's a good positive feeling out there that the Fed has been very successful in combating this inflation. But we're not out of the woods yet. And certainly there is the possibility that a recession could happen if the Fed waited too long, and that we start to see that the future employment numbers look much more dire. It would indicate that the Fed waited too long to cut interest rates. And that's sort of the concern of what traders have now. Uh, but overall, the outlook for credit availability for the marketplace has improved, or is at least improving. One of the things that we look at to track credit availability in the marketplace is the Federal Reserve's Senior Loan Officer Survey. And this is a chart that's showing the results of that survey. They talk to hundreds of loan officers at banks across the country on a quarterly basis, and they ask them what percentage of your loans are you tightening standards for, and what percentage of your loans you're not tightening standards for. And so the more positive this is, it means that the banks are answering, yeah, we're really tightening standards. We're making it much more difficult to get approved for loans. And what we see here in dark blue, this is their standards on new and used auto loans. And you can see that it's above zero where we are today, but it's been coming down and it's been falling. So it's essentially at zero at this point, suggesting that some banks, are, about 50% of banks are tightening standards and 50% of banks are not. And when we look at the broader economy, that's what's being shown in the lighter blue and the green lines, which is looking at commercial and industrial loans at small, medium, and large firms. And you can see that was very tight about a year ago, but now that's been improving. That fewer and fewer banks are saying that they're tightening their standards. So the purse strings are starting to loosen up a little bit, and that's going to be a positive sign for the auto industry, as banks are going to be a little bit more eager to make these auto loans because they know or have the expectation that the economy is doing okay and that the interest rates are coming down. The other thing we look at is auto lending. Well, how much money is being lent to the industry? And this comes from the Federal Reserve Bank and Equifax. And it's adding up the total amount of loans, new and used, that are being made available for loan originations in the vehicle market. And on the far right there, you can see where we are today. We've had a nice uptick from where we were in the second quarter, from where we were in the first quarter, but it's essentially flat on a year over year basis in terms of auto lending. So it's a little bit of a mixed bag. We're not seeing a big movement in terms of more auto lending actually happening out there. But one of the positive indications is that jumpy red line, and that is showing subprime share of auto lending. And what we can see is that back in 2007, 2008, subprime share was a much larger portion of the lending that was being done out there. Nearly 30% of all the vehicle loans that were being done were being given to folks that had subprime credit quality. A little bit more of the loans that are more likely to default, a little bit more risky. But you can see where we are today, that subprime share has fallen dramatically, and it's now closer to, say, 15 or 16% of the market. So the quality of the lending out there has improved dramatically. And so the quality of these loans, their risk in the marketplace is much better than it was, certainly better than it was during the Great Recession, because there's just not many subprime folks out there borrowing like we had before. But if you look at that jobbly red line, you can see over the last couple of quarters, it is turning up a bit, suggesting that there is more activity that's being done on the subprime share, more lending being done to subprime. Again, kind of reinforcing that idea that the purse strings are starting to loosen out there, and more credit is being made available. But one of the concerns out there is that delinquency rates are very, very high on auto loans. This is looking at, in red is showing subprime delinquency rates, folks that are 60 days delinquent on their loans. And then blue is the entire marketplace of delinquent. And they're on different scales because the subprime delinquency rate is much higher than the overall. But I wanted to kind of give you an idea of when we compare these lines that we're not as much dire situation as we might think we are. You can see that on the far right that severe delinquency rates for subprime have really skyrocketed. In fact, they're higher than they were during the Great Recession period, really suggesting that subprime borrowers in particular are having a very difficult time paying their auto bills right now. And that's true for the overall as well, that delinquencies have risen to historic highs. And so it does suggest that we are in a precarious situation with the lending out there, that borrowers are having a difficult time. But because we have a better credit quality borrower out there, we don't have as many subprime loans. The majority of these loans are not turning into actual defaults. People are still finding a way to actually pay that bill. So what I'm showing you here is the delinquency rate from the previous slide, the blue line for all loans out there, relative to the default rate, the loans that actually move into default and move into collections. And you can see that while the delinquency rate is at all-time highs, the default rate still remains well below the levels that we saw during the Great Recession. So not a positive sign necessarily, but it does indicate that the credit quality still remains quite strong, and that good credit that we've got out there is keeping the default rate from really skyrocketing to a much more dangerous level. But all of this suggests that there is pressure out there on the Fed to start lowering interest rates, because we know a lot of borrowers are really hanging on by a thread. And so this is certainly one of those metrics that we do not want to see default rate spike, because that would cause a lot of trouble across the whole financial sector, and not just automotive. So what we know, though, is that overall consumers are still stressed in terms of affordability. These monthly payments are still just a big challenge for them, and they've changed dramatically. This is a chart that's showing the average monthly payments. This comes from our dealer track data, and you can see a couple of interesting things that are emerging from this. One, that the rise that we saw in monthly payments during the immediate post-COVID period has now started to wane. We're seeing that monthly payments are starting to come down a little bit. We've moved past this sort of inflationary period that we had with monthly payments. And so that's positive. This affordability issue is improving a little bit out there for vehicle buyers, but it still remains at very, very high levels. The other interesting thing is that there's very little difference between the average used monthly payment and the average lease monthly payment. Usually, a lease monthly payment is a little bit higher, but and for folks who want all the bells of a vehicle, that makes that lease payment a little bit more of a value because they want that. But we can see today that the used market has really kind of leveled itself with leasing, and this is why leasing just is not that popular. If I can buy a vehicle for the same price I have to pay on a lease, we're seeing that the lease offers just aren't very strong out there to pull people into much more aggressive leasing. But all of this just means that this monthly payment issue is still lingering out there for households, and it's part of the reason that we're facing a major headwind in the vehicle market, and getting back to a 17 million market like we had prior to COVID is going to be a real challenge at these higher price points and these higher interest rates. One of the ways that consumers are mitigating these high vehicle prices is that they're moving to cash purchasing. This is a chart that's that's showing cash share of vehicle financing. So how do people actually buy their vehicle? And what we can see there in blue is that prior to COVID, about 12% of folks were actually paying cash for their vehicle when they bought it, and that's since jumped to about 20% of the market. So people were looking at these high interest rates and the high APRs that were being offered to them on a car loan, and they said, "Forget it. I'm only getting maybe 4 or 5% on my savings account. Why pay 8 or 9 or 10% on a new car loan? I'll just take that cash out, pay cash for the vehicle, and not have to sign up for that high interest rate car loan." And so we're seeing that across the marketplace. And in fact, in the used side, it's actually risen not as much as we saw on the new side, but in the used marketplace, cash purchasing is actually at a peak, 63% of the purchases out there. So again, it's indicating that this affordability issue is still lingering out there. But because we have a more affluent vehicle buyer with a little bit better credit quality, uh, we're not seeing any kind of collapse in the marketplace as a result of these changes that we've had with interest rates over the last couple of years. So overall, this is pointing to a new vehicle market that we really haven't changed our forecast much, but it's not a lot to be optimistic about. We still see us the vehicle market is on the recovery path, with vehicle sales getting a little bit better this year than they were last year. But it's getting to be more of a challenge. And we just got the August sales numbers, and the SAR came in at a 15.1 million selling rate. That was substantially below what we had done in July, which was a 15.8 million selling rate. So a much slower marketplace over the last month, which was a bit surprising. Most of the consensus forecasts were for a little bit more aggressive marketplace. One of the things that we did see change is that fleet activity from the manufacturers pulled back dramatically in August, down over 20% from a year prior. That's a little bit surprising, given that we know that for some brands, their inventory is accumulating. We know they don't want to go aggressive on incentives. So usually the fleet channel is sort of an off ramp or an exit valve for them. If they're seeing too much inventory, they can cut some deals out there to try and move some vehicles into the fleet channel. But the manufacturers appear to be cutting back a bit on fleet. They're not leveraging that the way they might otherwise. So it is an interesting move by the manufacturers, one that suggests they feel confident that consumers and the retail side of the business is going to hold up here in the fourth quarter to keep sales moving through the end of the year. Our overall forecast is that the sales this year are going to finish a little bit better than they did last year. We did about 15.5 million in 2023. We're expecting about 15.6, maybe 15.7, somewhere in that range for this year by the time we get to December. However, next year we're expecting the vehicle market to pick up a little bit. We expect interest rates to be substantially lower. We expect incentives to be higher, and for consumers to be a little bit uh, 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 more sound in terms of their outlook. And of course, a lot of the uncertainty about what the Fed's interest rate policies are going to be and how the election is going to turn out. All of that uncertainty is going to go away. So we remain optimistic that next year we're going to see better growth. Nothing fantastic, but certainly better than what we're looking at so far for this year. So we still remain optimistic, but there's still a lot that we don't know about, and that is the certain uncertainty ahead. And one of the things I just want to talk about is gasoline prices. And I know I've shown this slide to you guys before, but I really think that we have to keep our eye on gas prices, because nothing moves the needle on the American electorate and the mood in America than the price that we're paying at the gasoline pump. And just to give you a little perspective on what's been happening the last couple of years, as I'm sure you're probably well aware, gasoline prices have been very volatile. But what we saw in the immediate days after COVID came is that gasoline prices spiked dramatically in this country. They went from in April of 2020 to June of 2022, so just over that 2 year time span, they went up over $3.23 a gallon. That was a massive shock to consumers out there, that really in June of 2022, and that's when inflation peaked in the economy, if you remember from an earlier chart. This really sent shockwaves to the American consumer, and I think still has lingering effects today, because you can see where gas prices are now and where they were prior to April of 2020. Well, they're higher. And so these higher gasoline prices are hanging on Americans' mood that things aren't that great out there, because I'm paying, for many reasons, but for one, I'm paying substantially more for gasoline than I was before. And these gasoline costs are real money to the average driver out there. A dollar increase in gasoline prices will impact a typical driver out there about $50 a month. And this is a cost that you can't escape from. There's really not public transportation options out there. You can't really carpool. That's always difficult to do. So these are costs that consumers can't escape from. And that's why this is something that they watch very, very closely. So the reason why that's important, I should probably jump back just to point that out. If you look at the very end here, gasoline prices from the most recent data points, they've been coming down. And in fact, gas prices have been falling pretty regularly over the last 9 months. So gas prices are in a relatively positive situation as we head into the fall election. But overall, gasoline prices are higher by about 41% under the Biden Harris administration than they were under the Trump administration. So this is one of the big factors that we're dealing with out there going into this election. So this chart here I'm showing is consumer sentiment. And I think this is a very important chart because it really illustrates where we are as a nation. And you can see on the far right, we hit a bottom in this index in June of 2022. That's when gas prices hit that $5 a gallon and above across the country. We hit the lowest level ever measured for consumer sentiment here by the University of Michigan. And you got to go back looking at the double dip recession of the early 80s, the S&L crisis of the early 90s, the 9/11 terrorist attacks, the Great Recession of 2008 and 9, terrible times when consumer confidence really fell. All of that pales into comparison with how consumers felt in June of 2022. They felt things had never been worse in this country. We're starting to improve from there. You can see it's been a jumping line and where we are today, but we are up from the bottom. And that's because inflation is finally coming down, but we're still dealing with these higher prices that exist across the economy, not just for gasoline, but for many, many products out there. The price growth has slowed, but that hasn't changed that we're having to pay for these products. So all of this is weighing on the mood of Americans as we go into the election. And as you look at consumer sentiment, this is a collection of everybody. This is rich people and poor people. This is urban people and rural people. And it's Republicans and Democrats combined. That's the total. One of the things that the University of Michigan does though with their survey is they are able to split out what is your political affiliation and then what is your overall consumer sentiment. And so I pulled that data out here, and we can see that some very interesting things emerge. But looking at where we are today, you can see in purple, that's the average, but you can see Republicans in general are very, very pessimistic. And they're getting more pessimistic over the last few months, as you can see, as their line is heading down as we head into this fall election. While Democrats in blue, their sentiment had been falling, but the most recent data points saw it ticking higher. And that's actually in the change of Harris being picked as the candidate. I think that's probably one of the main contributing factors that you see that rising. But it's still, for everybody, below the peaks that we had in April of 2021, the post-COVID peaks. So as we head into this fall election, the mood out there is very, very different. And how the electorate goes into this fall election, if gasoline prices remain low, that's certainly going to benefit Democrats. If gasoline prices start to rise dramatically, that's certainly going to hurt the Democratic ticket. And so we have this uncertainty as we head into the fall election. And then one of the things that we're expecting is that depending on how you see the glass, is it half full or half empty, you may just want to wait until we get through this election before you're going to make a big purchase like a new vehicle. And so we do think that there is the possibility that the marketplace is going to slow here the next couple months as many potential vehicle buyers just kind of take a wait and see attitude for the election to just occur, get that figured out, and then I'll decide I'm making a big purchase like a new vehicle. When we look historically, that's actually what has happened during election years. This is a chart that's looking at the light vehicle sales SAR, the monthly selling rate during the election season. And I've looked at the year 2000, 2004, 2016, and 2020. And I'm not showing here 2008 and 2012 because the results don't really hold up because we were heading into a major recession and coming out of a major recession. And that really kind of muted anything else that was going on in the marketplace. But for these other time periods over the last 20 years, what we can see emerges is that the SAR heading into the November election tends to trend lower. And it appears that the marketplace is pulling back. Consumers are taking that wait and see approach that I mentioned until the election happens. And then once the results are announced, we can see there's a little bit of a surge in December before the market then moves on to whatever it's going to do past Inauguration Day. The one exception to this was in 2000, when we can see that in December, the market did not rebound. It continued to fall. And that, I think, can be attributed to the fact that we had no winner. A winner was not decided until December 13th of that year. So we had 36 days after the election where nothing was decided. But once that Gore conceded we can see that red line really starts to take off as vehicle buyers return to the market in time for January. So, as I said, our expectation is that we're probably going to see something like this year, in particular, with all of the uncertainty that's out there. That consumers are probably going to pull back just a little bit. So that's something to be aware of out there. When we think about the outcome of the election, well, I think it's probably safe to say that if Harris wins, there's probably not going to be a lot of changes to automotive policy. She's already said that she's going to continue on with many of the Biden administration policies regarding the Inflation Reduction Act and EV mandates and all of the legislation that has been passed in the last couple of years. So there's not much to think in terms of change from a continuation of these policies from Harris. If Trump takes office, though, there's a lot of things that could change. And what could change? Well, that's the hard part because there's really almost anything is on the table with President Trump. And I'm trying to think about what's the best way to try and capture what's ahead of us. And I was reminded of the old Donald Rumsfeld quote, who was the former Secretary of Defense during the Iraq War in 2002. And he had a great quote where he was talking about trying to find weapons of mass destruction and the risks out there. And he said, there are known knowns. There are things that we know we know. There are also, we also know there are things of known unknowns. That is to say, that we know there are some things we do not know. So unknown unknowns, the ones we don't know that we don't know. And if one looks throughout the history of our country and other free countries, it is the latter category that tends to be the difficult ones. And with President Trump, there's a lot of known knowns and there's a lot of unknown unknowns. When we look at the known knowns, we know he's come out aggressively to want to implement many protective tariffs to try and keep domestic manufacturing protected out there. He's talked about implementing a 10% tariff or more on every vehicle imported, 100% for Chinese battery electrics. President Biden has already matched that himself. But we also know that President Trump implemented tariffs on steel and aluminum back in his previous administration, which impacted vehicle production costs dramatically. And certainly other commodities and products could be added. We also know among the known knowns that unions are going to get significantly less federal support than they may have had under the Biden-Harris administration. So those are some of the things that we know are going to change out there. Some of the known unknowns is what's going to happen with these EPA mandates and the battery electric credits. Do they survive? Former President Trump has stated he's got strong opposition to these auto industry policies, but there's a lot of money that's already been spent and a lot of investments that have been made. It seems that it would be very difficult for a reversal of these policies to be implemented by President Trump. It seems like one of the easiest things to do would be just to get rid of the mandate, the timeline on these things, and just leave everything else in place. But again, we just don't know what he's going to do. Of the unknown unknowns, well, there's many possible changes with the right supporters, but certainly safety regulations, environmental around the auto industry, CARB regulations. Can California and the other CARB states negotiate different policies from the federal government? That may be something that could be directly under challenge in the Trump administration. And of course, direct to consumer laws. It seems to me that with Elon Musk having the president's ear, that's something that could be reviewed as well. So certainly a lot that we don't know with a potential new President Trump administration. But one thing we do know is I think that there would be a complete agreement from both Republicans and Democrats that we've got to keep these Chinese electrics out of the U.S. market. I'm showing here the BYD Seagull, which is really a nice little vehicle for $12,000. So even with 100% tariff on this thing, it's $24,000. Very, very affordable product. Charges very quickly, can go about 300 miles on a 10-minute charge. Could be a very competitive product in the marketplace. But we all know that the industry is going to need some protection from these Chinese imports. there's a lot of jobs that are at stake, and so I think regardless of who the administration is, we're going to see an aggressive policies to keep these electric vehicles out. There is a case to be made, though, that that does not come without a cost. That yes, we may protect automotive manufacturers and those jobs, but making American consumers have to pay very, very high prices when a much more affordable product may be out there may not be in the best interest of American consumers. So this is something to keep an eye on here as we go forward here into the next wave of the battery electric revolution. So one of the other things I was just talking about the consumer confidence survey from the University of Michigan. Cox Automotive also does a survey where we do the dealer sentiment index when we talk to hundreds of dealers around the country and get their views on the marketplace. This is our second quarter numbers. We've got third quarter numbers coming out, I think, in the next week or two. But on our most recent data points, we can see that overall dealer sentiment remains rather muted. Anything before below 50 suggests that you have a bit of a pessimistic outlook on where the marketplace is operating at. And you can see that today we're looking at about 42 for overall, with franchise dealers a little bit more optimistic than independent dealers. But everybody's kind of taken a wait and hold and see pattern here over the last few quarters of being a little bit cautious on where the marketplace is operating at today. When we ask them, well, what is your expectations for how the market's going to be 3 months from now? Well, you can see our most recent data points suggest that pessimism is growing, that both independent and franchise dealers are saying that they expect the market to be a little bit tougher 3 months from now. And so that pessimism is spreading out there, that the marketplace is, this uncertainty in the marketplace is creating more challenges for vehicle sales. The other question we ask many of the dealers out there is, how is your inventory and profits? And what we can see here is with the green line there is how would you describe your profits over the last 3 months? Well, you can see it's actually ticked up a little bit in the most recent quarter, but it's far below the early, the low to mid 80s that we had during the 2021-2022 period, when margins were incredibly strong and profitability has fallen from those high levels to more of a negative position today. But the inventory situation appears to be well in the rear view mirror. We ask, how would you describe your current new vehicle inventory levels? And you can see from where we were just 2.5, 3 years ago, where we were looking at scores of 13 and 14. Well, it's risen dramatically. And now dealers are saying that there's plenty of inventory out there. And so this issue is not a problem, but clearly inventory rising appears to have a negative impact on overall profitability. And that's something that's going to be a challenge going forward. So one of the other things we asked is the dealer sentiment index, or what are the factors that are holding back your business? And of course, it's interest rates are number one, and the economy and market conditions. But where we saw the biggest movement was the political climate. It's now the fourth largest issue that dealers are saying is holding back their business. Over 1 in 3 saying it's a major issue, and it's moved significantly higher over the last quarter. So as this election approaches, that uncertainty is rising out there. And so I do think that we're all going to be sitting on pins and needles here over the next couple of months. And consumers, I think, are going to be sitting on pins and needles, maybe waiting, taking a break before making a big vehicle purchase until this whole election is figured out. All right, so let's talk a bit about what's going on with the different brands. So year to date, vehicle sales are up almost about 2%. But we can look at some of the different, looking at the large brands here, there's quite a large variation as to how the different brands are performing so far this year. We can see that Volkswagen is so far leading the way with 25% year over year growth in sales. Much of this can be attributed to really fantastic sales coming from the Volkswagen Jetta, which is up almost 100%, or the Volkswagen Atlas, which is up almost 40% on a year over year basis. That's really lifting Volkswagen, and they're followed closely behind by Mazda and Toyota and Honda, all showing strong growth, and much of it on their smaller vehicles. Particularly Toyota and Honda are seeing some of their compact car sales doing quite well, and that's lifting their totals. At the other end of the spectrum, you can see Ram trucks down over 25%, and then followed by number two by Jeep. And this is an issue that Stellantis is having. They have a huge problem with Ram and Jeep. As I'll show you a couple slides, I think will explain part of the situation. But just to give you a preview, I think really the issue that Ram is dealing with is that they got much more aggressive with the type of product portfolio that they're offering. Same for Jeep. They dropped a lot of their lower cost products, particularly the Jeep brand, and they moved into a higher price point that I think has left many of their customers behind. They just can't afford these high vehicle prices of where they are today. And so I think that the issue for Stellantis is one that's not going to go away anytime soon. Looking at new vehicle inventory, this is the current totals we're looking at from our vAuto data. And this is a summation in gray of the total count of what is on dealer lots and what is in transit across the country. And we can see that right now we're looking at days of supply up there of around about 2.9 million, a little bit below sort of the pre-COVID levels that we had of about 3.5 million or so. But certainly inventory is back to more or less pre-COVID levels. And certainly we have much more today than we had a year ago, about 900,000 more units, about 46% more inventory on the ground today than we had this same week a year ago. And days of supply has also appeared to stabilize, although this chart looks a little bit crazy. The days of supply, or how long that inventory will last based on our current sales pace, we're currently looking at about a 72 days of supply. It's a little bit lower than sort of the pre-COVID numbers that we had of more in sort of the 80 range. And you can see it's been a bit volatile here over the last couple of weeks. That's due to our measurements capturing some of that CDK reporting issue. It's kind of messed up some of our numbers from back in June and July. So our chart looks a little bit choppy out there, but that's starting to move past. And we're seeing that the market is pretty much more or less remains where it was prior the CDK outage issue. But overall, the inventory situation has improved dramatically. But that's not the case for everybody out there. And when we look at the different brands, they're in a very different situation out there. It's quite varied. Overall, we're looking at about 72 days of supply. You can see that right in the middle. But on the far right, you can see both Jeep and Ram are looking at days of supply well into the mid 100s, 130, 140 days of supply, a tremendous amount of inventory that's accumulating out there. And in fact, Stellantis just announced today that they're going to cut back some production at certain factories so that they're not making more of these products because they've already got too many. But at the other end, you can see you've got Toyota, Lexus, Honda looking at days of supply well below the national average. And this is allowing that Toyota and Honda to remain relatively firm on pricing, not to have to get too aggressive on their incentives. And it's really been a much different marketplace out there for them. I think one of the things we can point to is their hybrid products in particular selling like hotcakes. That's really been a big boon for them. So while overall the inventory situation has improved for the whole marketplace, where we stand today is that the different brands out there are in a much different situation and have to have their own strategies to deal with that. We would expect that those brands that are looking at inventory accumulating dramatically to have to get much more aggressive on incentives in order to get their product portfolio in balance. And looking at incentives, we can see that pricing out there has started to weaken, and this is getting at that affordability issue for consumers, improving just a little bit. We have a couple measures that we look at to try and gauge how incentives are doing out there, and it comes from our Kelley Blue Book data. And the blue line is showing incentives as a percent of the transaction price. And you can see that prior to COVID, this was sort of in the 10 to 11% range. That was the average incentive relative to the transaction price. But during the very lean inventory times of 2022, this fell to just 2%. So incentives fell to nearly nothing during this lean inventory time, but they're now starting to rise, and they've been rising as the inventory situation has been improving out there to where we stand today, that it's about close to 7% is the incentive relative to the transaction price. The other metric we look at is the price strength, or what is the transaction price relative to the MSRP, and that's that green line. And we can see that prior to COVID, this was around the 95% range was the price relative to the MSRP. But during these lean inventory times, it rose dramatically to almost 102%, meaning essentially the MSRP plus its destination fees was the transaction price. There was very little negotiation to be had. But as inventories returned, so did the discounting, and we can see that green line has now moved down back towards more pre-COVID levels. So all of this is meaning the price out there is starting to weaken a bit, and that's helping to keep vehicle sales hanging on and not seeing any kind of major collapse, even though there is these high interest rates and this incredible amount of uncertainty out there. The other interesting thing is what's going on with the different segments. And I pulled out the top 10 vehicle segments. They represent about 86% of the market. And you can see on the far right that the big sellers so far this year, subcompact SUV, up about 20% year over year, followed by compact car, up almost 16% year over year. And I think it's very interesting that we have, two of the most affordable car segments are showing the strongest year over year gains. And I think it's just reiterating that idea that affordability is still a major issue out there, and that consumers are being forced to look into products that they can afford to buy. And what are they shifting away from? Well, they're shifting away from more expensive products. And what are we seeing? Well, we're seeing mid-size cars actually down substantially from last year. Mid-size SUV down. So it does appear that consumers may be keeping the functionality. They need a car, they need an SUV, but they're opting for the smaller size because that's what fits more within their budget. So when we look at transaction prices overall, well, they've started to come down a little bit. This is a chart that's showing our Kelley Blue Book average transaction price, and I've got it going back to January of 2012. And where we stand today, we're looking at average transaction prices of about $48,400. That's down about a 0.5% from where we were a year ago, and it's down from the near 50,000 that we had in December of 2022. And as you can see, over the last, really the last year, prices have been starting to moderate or come down just a little bit. We're off this inflationary path, and you can see I've highlighted in red that was really that inflationary bump that we got in the new vehicle market. Had prices continued on sort of their normal trend prior to the supply shortage that we were facing, we'd be looking at more $44,000 price point today. So prices are definitely still up about 10% or 12% from what they might be normally. And that's really that inflationary environment. And that's going to, I don't know that we're going to get all the way down, but we'll probably see overall transaction prices come down a little bit more before we see things really stabilize. And this also means that some of the different brands are very vulnerable out there. We know that the price changes overall have been very different, just like we saw with inventory levels. The pricing strategy has also changed quite a bit. The average transaction price nationally from calendar year 2019 to what it's been so far this year, they rose about 27%. But we can see that for some brands like Jeep, the average transaction price almost 50% from where it was in 2019. Similarly for Ram, you can see it's up 40%. So as I said, it's not surprising when we look at their year-to-date performance as being down substantially. In large parts because their average transaction prices have moved much higher. They've priced themselves out of their customer segment's ability to buy. Where we're seeing on the far left that prices have not moved as much. Certainly, Tesla's got some price cuts because they've been doing some crazy stuff on their pricing of vehicles. But Buick has seen prices really just rise very, very little over that 5-year span. Subaru and Volvo are basically looking at just 15% price increases. One would think that if we do have a downturn or things get more difficult in the economy, those brands that made substantial price increases in their product portfolio are going to be much more vulnerable than those brands that have not made a dramatic change in their average price point out there. And so it's going to be quite varied out there in terms of what the risks are of what folks are facing. The other thing I just want to mention is alternatives. I know there's a lot of talk that nobody wants battery electrics anymore. The whole wave is over. Well, that's just not true. We're still seeing battery electrics are selling, and they're selling better than the overall market. Overall market so far year to date's up about 2%. ICE vehicles, though, internal combustion engines, they're about flat. They really have not improved. Where we're seeing the biggest gains is in plug-in hybrids and traditional hybrids, up 44 and 36% respectively. Battery electrics year to date are still up about 6%. Nowhere near the levels that we all were expecting a little over a year ago. We thought it would be much more aggressive in terms of the adoption rate of this vehicles, but there's a lot of competition out there for them now. And certainly coming from the traditional hybrids with Camry going full hybrid, as well as a lot of plug-in hybrid options being available out there. That's provided a lot of competition for new electric sales, as well as the used electric market competing with the new electric market. So it's a real challenge out there to get to a much more aggressive pace on battery electric adoption. But we still remain optimistic that battery electrics are going to continue on the growth path, maybe not as aggressively as we had thought before. But we do know that alternatives overall are approaching about 20% of the market. And certainly the battery electrics and plug-in hybrids, that $7,500 tax credit from the Inflation Reduction Act is certainly contributing to their vehicle sales. And I think it would be a real challenge for a new Trump administration to simply throw that out because it is almost 1/5 of the marketplace today. All right, lastly, before I run out of time, I just wanted to mention real quick a couple of things about the used market. Our auction prices out there at the Manheim auction, they've been coming down from the peaks that we've had over the last couple. We hit a peak way back about 2 years ago. The prices have been coming down. Our most recent data point from July actually showed that it was up a little bit. So we did see a bit of an uptick. But all of this is suggesting that we're starting to see the price that we've had the major declines. The rate of decline is now going to slow substantially, and we think used prices are going to start to stabilize out there. We know that used sales are running about 1 to 2% higher this year. That dealers are looking at relatively constrained marketplace. They don't have a whole lot of used inventory. They've stayed relatively lean and mean out there on the used market. But the prices themselves continue to fall a little bit as consumers are challenged to pay these high prices at these high interest rates. Dealers are being forced to cut prices in order to make that deal. But all of this, we think, is going to start to change because we know that the future supply of used vehicles is going to get more challenging. This is a chart that's looking at lease maturity. So those new vehicles that were leased about 3 years ago and are going to be coming off lease and back to the used vehicle market. And this was running at about 350,000 a month. We've fallen dramatically from the peak we had back in 2019 and 2020 to where we are today. Going forward from here, we know over the next year this is going to get even tighter. That as the lean sales times of 2021 and 2022, when COVID was raging and vehicle sales were very muted, that is going to start hitting the used marketplace here over the next year, and supply is going to get really tight. And we think that's going to help strengthen used vehicle prices because finding these off-lease vehicles, these gently used CPO type products, is going to be a real challenge in the marketplace. And we think that unfortunately for dealers trying to acquire inventory, you're going to have to pay up to try and get those vehicles. And so overall, what our outlook is for used vehicle values for the year, we're essentially, this is where we think the Manheim index will finish on a year-over-year basis come the end of December. Well, we expect that this year prices are going to finish down about 2% from where they were a year ago. And this is in December. But we expect that by the end of next year, we're going to see prices actually on the positive side finish up about 2%. And so the big increase we had of almost 47% price increase in 2021, and then the almost 15% decline that we had in 2022 and 7% in 2023. Well, that's going to start to fade away, and so we do expect that by the end of next year, we're going to see the used vehicle market back in much more normal territory of modestly growing vehicle prices. So that's just a brief summary of what we're expecting out there. I won't jump into that one, but if you guys are looking for additional analysis or want to stay up to date on what Cox Automotive is seeing out there, we publish all kinds of articles on a regular basis on the Cox Automotive newsroom. I urge you to take a look at that on a regular basis. You can see what myself and our chief economist, Jonathan Smoke, are saying about various events within the industry as well as within the economy and what it means for the automotive market. A lot of good information there. I urge you to stay up to date with it. So with that, those are my comments today, and I hope that that's been informative for you. And if you have any questions, please feel free to drop me a note. I'd be happy to answer them for you.
Charlie, thanks so much for joining us today. We always love having you on, and we look forward to having you back in December to wrap up the year and the election, and I'm sure we'll have another interesting presentation from you. Again, you'll all be receiving a copy of this webinar by the end of next week. Join us back here on Tuesday, September 17th, as we delve into the webinar, Absorbing Data Innovation into Your Operation and Preparing for What's Ahead. So be on the lookout for promotions. For more information about AIADA, visit aiada.org. Thanks for joining and have a great day, everyone.